Let's talk about something the financial services industry doesn't want you to know. Most retirement withdrawal strategies are garbage. Today, I'm rating every major withdrawal strategy from 1 to 5 stars. I'm Eric Rodriguez. I'm a certified financial planner, and I've spent 15 years watching retirees with $2, $3, even $5 million get fleeced by outdated advice. The best strategies deliver 30% more income than traditional approaches, but the one your current advisor recommended, 2 stars at best. And stick around. The 5-year strategy I'm revealing at the end could put an extra 400 grand in your pocket over retirement. Let's go. Here's how we're scoring these 4 criteria. Tax efficiency, 40% of the score. If you're handing the IRS 300 grand plus you didn't owe, I don't care how simple your strategy is. In my opinion, you failed. Flexibility, 30% of the score. Markets crash, healthcare spikes, life happens. Your strategy needs to bend without breaking. Simplicity, 20%. Don't confuse simple with lazy. And lastly, longevity protection, which is 10% of the score. Not running out of money is the floor, but it's not the ceiling. Our example we're going to be using today, we're going to be using a couple, build 62, with on average $2 million across their IRAs, their taxable accounts, and their Roth accounts. They want $100,000 a year before Social Security starts coming in at age 67. This is probably you, or at least close enough. The worst strategy I'm about to show you, it's what most people do. When you see the math, you're going to be furious. Let's start at the bottom. 1 star. These strategies should come with a warning label. First, draining your IRA early because you have to take RMDs anyway. This is the financial equivalent of eating dessert first because you're going to eat it eventually. It's toddler logic dressed up as planning. Here's what actually happens. You're 62, you take 100 grand from your IRA. Congratulations, you just paid 22 to 24% on money you could have converted at 12%. Those years between retiring and RMDs at 73, that's a decade-long tax sale. So you could be doing Roth conversions at the lowest rates of your life. Instead, you're paying full price and calling it a strategy. Here's how the math works. On a $2 million portfolio, this approach costs you $200,000 to $300,000 extra in lifetime taxes, and you've eliminated tax diversification for later. At 75, RMDs force huge IRA distributions, higher brackets, IRMA surcharges, more Social Security will be taxable. It's a tax disaster wrapped in the illusion of planning. For tax, I give this 1 out of 5. Flexibility, 2 out of 5. Simplicity, 5 out of 5. Longevity, 2 out of 5. 1 star. Don't do this. 1 star's disasters are obvious, but the 2-star strategies actually sound smart at dinner parties. That's what makes them dangerous. 2 stars. Won't destroy your retirement, but leaving serious money on the table. I bet at least one of these sounds familiar. First, living off dividends and interest only. That sounds safe and conservative, right? But here's the fantasy. $2 million generating 3% in dividends. You live off $60,000, never touch the principal, die with $5 million, and feel like Rockefeller. Here's the reality. You need $100,000 to actually live your retirement. So you're either living very, very conservatively with $2 million in the bank, which is insane, or you're panic selling to cover the gap. It's like ordering the most expensive wine on the menu and adding Sprite to it. It's technically drinkable, but why would you do that? I give this 2 stars. Next, pro rata withdrawals. Taking money proportionally from all accounts based on their percentage of your total portfolio. So here's what this looks like. $2 million total. We're going to take 1.2 million of that in IRAs. So that's 60%, 600,000 in taxable, which is 30%. So $200,000 in Roth at 10%. You need $100,000. So what pro rata says is you're going to take $60,000 from your IRA, take $30,000 from taxable, and $10,000 from your Roth every single year, like clockwork. This is what most robo-advisors do, and it's fine. It's not terrible. You're diversifying tax liability, which sounds smart, but here's what you're missing. Tax bracket arbitrage. So let's say you're 63 before Social Security in the 12% bracket with room to spare. Pro rata is saying take $60,000 from your IRA, but you could take $80K from your IRA, stay in the 12% and do a Roth conversion on top, maximizing that low bracket while you have it. Or flip it. You're 68, Social Security started, and you just sold a rental property, 24% bracket. Pro rata still forces $60,000 from your IRA. More taxes. The smarter move, more from taxable at a 15% capital gains rate and less from your IRA to avoid going higher. Pro rata treats every year the same, but your tax situation isn't the same every year. It's the tofu of withdrawal strategies. Technically food, zero flavor. So I'm going to give this from a tax perspective, 2 out of 5 score, flexibility, 2 out of 5, simplicity, 5 out of 5, longevity, 3 out of 5. So 2 stars. You can do so much better. Real talk, if you're using a 1 or a 2-star strategy, don't panic. Most people are. The industry sold this for decades. What we're going to do, we're going to fix that. 3 stars is what we're going to be talking about next. And this is where it gets really interesting. So 3 stars, it's not embarrassing territory. It's probably what you've heard other financial advisors discuss and use, maybe even other videos. It's decent advice, but it's just not great. So here's the traditional playbook. Spend the taxable money first, then the tax deferred, then the Roth last. Most planners have taught this for decades, and honestly, it's not bad. The logic makes sense. You drain your taxable accounts first. It's already after tax. Then hit the IRAs, save the Roth for last, and it grows tax-free forever. But for our $2 million couple, they're going to spend down $400,000 in taxable over 4 years. Then they're going to switch to IRA withdrawals and never touch the Roth. But here's where the research gets interesting. Morningstar came out with a study and they said static withdrawal strategies max out at 3.9% safely. So on $2 million, that's $78,000 per year. Here's the problem. You drain your taxable accounts by age 66. At 67, Social Security kicks in. Suddenly you're forced to take everything from your IRA. Your income jumps, Medicare premiums jump, aka IRMA. Higher capital gains bracket, it all stacks up. So the better move is to keep some taxable invested, do Roth conversions in those low income early years. You build tax diversification for later, which, spoiler alert, is exactly what the 5-star strategy does. So here's how I'm ranking this. From a tax perspective, 3 out of 5, flexibility, 2 out of 5, simplicity, 4 out of 5, and longevity, 4 out of 5, total score of 3 stars. The Applebee's of retirement strategies. It's familiar. It won't kill you, but you're capable of better. All right, we're getting close. 4 stars is where sophisticated money lives. This is what I recommend for most clients, but even this isn't the top. 4 stars is rare territory where smart money lives. Just this approach and you're ahead of 95% of retirees. Tax bracket management with strategic Roth conversions is going to be the focus here. So here's the play. You're 62, Social Security hasn't started. You're in the lowest tax bracket you'll see for 30 years. This is your window. You take $60,000 from your taxable account. Qualified dividends and long-term gains taxed at 0 to 15%. Then, and this is where most people's brains short circuit, you're going to convert $40,000 from your IRA to your Roth, staying in the 12% bracket. Wait, you're telling me to pay taxes on purpose, Eric? Yes, because you're paying 12% now to avoid 22 to 24% later when RMDs and Social Security force your hand. Convert $200,000 over 5 years at 12%. That means you're going to pay roughly $24,000. The same money at RMD time at 24%. Now you're going to pay $48,000. So you just saved 24 grand by doing that. That Roth now grows tax-free forever. At 80, paying for long-term care, you pull from your Roth. There's no IRMA, no taxable Social Security. This typically saves $150,000 to $250,000 over a lifetime. That's not a rounding error. That's a Lamborghini. So why only 4 stars? Well, it requires you to actually think every year. You can't set it and forget it. But for $2 million plus, it's a small price for a 6 figures in savings. So again, here's how I'm ranking it. 5 out of 5 on tax, 4 out of 5 flexibility, 2 out of 5 simplicity, 4 out of 5 longevity for a total score of 4 stars. And this is for clients who actually want to win the retirement game. Now, here's what you've been waiting for. The 5-star strategy that can increase your income by 46%. And we're going to again talk about real numbers, real client scenarios. 5 stars, the gold standard. And this isn't just my opinion. It's backed by Morningstar's data. What Morningstar says in their recent research is the guardrails dynamic strategy delivers the highest starting withdrawal rate at 5.2%. That's 30% more in income than the traditional approaches. This is what we call the dynamic guardrails approach. Remember that $78,000 per year from the 3-star strategy? Watch what happens here. So again, let's say you have the married couple. We're going to call them John and Mary. They're both 63 as an example. They have $2.1 million. So their guardrails, they're going to have a baseline of $100,000 withdrawal, about 5%. Their upper guardrail is going to be 4%, and their lower guardrail is going to be 6%. So 3 very different market years, and here's how it plays out. So year 1, 2021, the market's ripped, up 24%. The portfolio grew $2.6 million. At $100,000 withdrawal, they're at a 3.8% rate below the 4% upper guardrail. So time to increase spending. We bumped them to $120,000. So now they have an extra $20K from their taxable that they can pull out so they can harvest gains at 15%. Plus, they can also convert $45,000 from their IRA to Roth at 12% before Social Security starts. They took the trip to Italy. We paid 12% on money that would have been taxed at 24% later. That's a 50% discount on the tax bill. Now watch what happens when the market flips. So year 2, 2022, market's cratered. Now they're down 18%. Portfolio dropped to 2.15 million. So at 120K spending, they're at a 5.6% withdrawal rate, approaching the 6% lower guardrail. So now it's time to pull back. We're going to cut spending to 105,000, skip a lot of discretionary income. They're going to delay the new car they wanted to buy, etc. Not fun, but necessary and sacrifices they have to make. But here's where the magic happens. Their income dropped by $15,000, even lower tax bracket. They pull $105,000 from the IRA to live on, then convert $80,000 to Roth at 12%, paying $9,600 in taxes on money that would have cost them $19,200 at the 24% tax rate. The market gave us lemons, but we made Roth conversions. Year 3, 2023, markets recovered. The portfolio is now at 2.8 million. The upper guardrail is now triggered. So now we're spending back to 125,000, harvest more gains, moderate conversions. They can finally buy that new car, go on the fancy vacation, gift to whoever they want to give to, etc. Much more flexibility there. So 3 years of boom, crash, and recovery. And here's the scorecard. They spent $350,000 total, 17% more than a rigid 4% rule would have allowed. They converted $205,000 to a Roth at 12%. On average, saved about $24,600 in taxes on the conversions alone. The portfolio grew to $2.8 million despite a brutal 2022, and they lived their retirement instead of hoarding money out of fear. So this is 5-star execution, not following a formula, responding to reality. As markets go up, you spend more, harvest gains, keep converting. Markets go down, you spend less, convert aggressively, build Roth. And Morningstar's 2025 report, what they're explaining is flexible guardrail strategies support 5.7% withdrawal rates versus the 3.9 static. That's 46% more in income with the same portfolio, but just a better strategy. So here's how we rank this. From a tax perspective, 5 out of 5. Flexibility, 5 out of 5. Simplicity, 1 out of 5, because it does require a little bit of expertise. And in longevity, 5 out of 5, 5 stars total. So this is the kind of strategy we build at my firm, WealthBuilders. This is not a do-it-yourself territory because you need the software, you need the expertise and the discipline to cut spending in those down years. Most advisors, quite frankly, won't do this. It's too much work, but for $2 million plus, it's worth every single penny. Look, I get it. You've worked your whole life to build $2 million. You saved, you invested, you didn't panic during crashes. You made it to the finish line. It would be a shame to fumble it now with a mediocre strategy just because nobody told you there was a better way. Most advisors are not trying to screw you over. They're just comfortable. They learned one approach and they're sticking with it, but the research has moved on. We now know 5.7% is a sustainable withdrawal rate and with dynamic strategies, not the old 3.9 to 4% that we hear all the time. That's not a minor difference. That's a different retirement. Remember that couple? They can go to Italy year 1, tightening the belt in year 2, and then buying the car in year 3. Well, that's what intelligent flexibility looks like. So if you would like help creating your 5-star strategy, we're here for you. You don't have to do this alone. If you already have a large nest egg saved, that's fantastic. And you've already proven you're really smart with money and you're very disciplined. Now let's make sure that you keep it that way. Feel free to click the link below in the bio. You can book a complimentary phone call with myself and we can get you on track to a 5-star plan. Thanks so much for watching and I'll see you in the next video.